around. Okay, so we are going to talk about the categories of the traders in the financial market, because we just hear about, oh, traders this, traders that, but what type of traders do we have out there, and how can we use this to our advantage as traders? That is a good question. So let's start talking about what we are going to learn today, why trader types matters. And also the purpose of this lesson, number one, is to learn 3 major trader categories that there is. And then the second one that we are going to understand from this session today is how we can understand who these type of traders are, why they trade, how they impact markets. We are also going to learn how professionals hedge risk or speculate for profit. So this is also what we are going to take from or learn from this session today. And then we're also going to understand, we are also going to learn, okay, that not all traders are in the market to make money. It is very important to understand when it comes to that, sir. Okay, not all traders are in the market to make money. Okay, though it may sound a little bit, of you know, like unconventional, because we believe that for somebody to be a trader, they are supposed to be there with an intention to make money. But it is also important to understand this unconventional idea that it is not every trader who is out there is there to make profit. That is the point. Okay, so welcome today, everyone. Sister Jolis, Brother Blessings, and Brother Makasa. So every one of you, I welcome you today. So you're not that late. Today we are going to be talking about the key categories of traders in the financial market. That is what we are going to be talking about today. The key categories of the financial market, of traders in the financial market. So from today's lesson, you're going to learn 3 major traders categories that we have as traders or on the financial market. Secondly, you also understand who these traders are, why they trade, and how they impact the market. So we are also going to understand, because you have just been seeing, oh, the market is bullish, the market is bearish, but we don't understand exactly what is happening. And then you're also going to learn how professionals hedge risk or speculate for profit. So these 2 important points, hedge risk and also speculate for profit. So to hedge risk, these are the types of trades where you can buy and sell at the same time. Okay, so it is different from speculations. And then we are also going to learn another important point, that not all traders are in the market to make money. Some are here to protect their business. So though it sounds a little bit unconventional, but it is a very, very important point that we have to learn from today's session. Okay, so let's try to understand about the key definitions, okay, or key concepts of today's topic. Okay, so let's try to understand a trader. Who is a trader, by the way? Okay, a person or institution that buys and sells financial assets, okay, like livestock, commodities, and currencies, okay, or futures, okay. So a person or institution that buys or sells financial assets, stuff like stocks, commodities, currencies, or futures. Okay, so we also have another, the first one is us trying to understand the definition of a trader. And then the second one is us trying to understand the first type of a trader. We have hedging. Okay, what is hedging? Okay, so hedging is reducing, okay, managing financial risk by locking in prices or offsetting potential losses. So particularly from this definition of hedging, which is to reduce or managing financial risk by locking in prices or offsetting potential losses, this is where you buy a product, right? You buy, let's say you're in a trade, you have bought gold or any currency asset, and then After buying, you see that you're getting to be in loss. So after doing that, after you see that you're getting in a loss, you sell again. So as the market is dropping, okay, it continues to sell. The sell positions that you had entered are going to put you in profit. So this is what they mean that it is by locking in prices or offsetting potential losses. So how are you going to offset potential losses? So if you buy, let's say you buy 4 positions and then they put you in a loss. After that, you see that you are getting in a loss and the trade keeps on selling. That is a simple definition that I can put on. And then you enter a sell. You are hedging. So to hedge is you reducing the losses or the risk by doing a sell and a buy at the same time. That is what it means to hedge. And then we have speculation. This is taking on risk with the goal of making profit from price exchange. Okay, so here, just this speculation and hedging, these are independent type of traders. Okay, so here we have these people who are trying to hedge the market by reducing or offsetting the potential losses. And then we have speculators. So they love taking on risk with the goal of making profit from price changes. Now, let me be clear. I remember last time we had a session where I said that, do you know that many of these big traders, they don't hold the market for far too long? Number one, their secret to making money is that they open the trade position using a bigger lot size. Let me give you an example. If you have a $200,000 account, practically speaking, you're using proprietary trading funds, which have been funded at $200,000. So you see an opportunity that maybe NASDAQ or gold or any currency is going to start dropping, particularly when you see those key areas of support and resistance where you expect the market to react. And then let me give you an example. You open maybe a 20 standard lot size where you're making a $200 profit per pip. And then once the market reaches in those key areas, it immediately starts dropping. Okay, so you're making profit by price change, or the other name for price change, sorry about that, the other name for price change is price fluctuation. It is important to understand that. So we have speculations or speculators. And then hedging. Hedging, this is where we get the name for hedge funds, okay? So hedge funds, these guys, they hedge the market to protect potential losses and to protect their account from to incur further losses. Now, we also have commitments of traders report, or also known as COT. Though today, I want us to lay a foundation on this by simply going through a theory. And then the next, we are going to go in details on how you can mix a COT report with the actual analysis to match what you're seeing on the COT report with what is happening on the chart. So what is Commitment of Traders Report? This is a weekly report by the CFTC, okay, showing positions held by large traders, categories in the future market. Let's go deeper. Don't worry about most of the definition. You're going to learn them as we proceed. So let's talk about category. Here we have definition and category. So we have 3 types of traders. We have commercial traders, and we have non-commercial traders, and we have non-reportables. So who are commercial traders? These are institutions using markets to protect their business from price changes or hedges. So these guys, they protect their business by hedging, okay, these commercial traders. And out of these 3 types of traders, we are going to understand who is in charge of moving the market, who is in charge of breaking out of consolidation and setting the trend. And it is also important that today's session is going to help you to know which currency pair or trade you should take. You're not just going to be buying or selling. You learn how to match this category and also how to follow. You learn who is driving the market, who is in charge of the trend today. So we have Also, the second one is non-commercial traders. So these traders aim to profit from price movements, and these are also known as speculators. In the first place, the commercial traders are also known, the other name is hedgers. Let me give you an example. In America, most people, retirees or other people, they love investing their retirement packages in hedge funds. This is the reason why these guys, it is always their purpose and role to protect their business from price changes. Okay, so they hedge. And they make profit by hedging, by both buying and selling. If they buy and sell, either the market goes the other way, they will ensure that the position, if the market strong direction is buying, they will put more orders and invest their money in that direction. And if the market keeps moving, their sell position will be negative, but they won't be in negative compared to the profit that they are going to make if the market starts going towards the direction of the other trades, known also buy trades. Non-commercial traders, these aim to profit from price movement, okay? So they don't care what happens on the market because their interest is in making profit, simple. And then we have non-reportable or traders, non-reportable traders. These are small traders whose positions are too small to be tracked individually. This is where now you and me fall. We fall under this category. And most financial institutions, those small financial institutions, they fall under this category, okay? In simple terms, we cannot be tracked because we have no capacity to move the market. Let me give you an example. Do you know that it takes $100,000 to move the market by 1 pip? That means you need to have 1 million USD to move the market by 10 pips. 2 million USD to move the market by 20 pips, and 3 million USD to move the market by 30 pips, which simply means that if that is your only capital that you have, there is a possibility of you losing the money. Why? Because you are going to be big traders with huge amount of money who don't care about us small traders. Okay, and it is also important to understand that the money that you make, there is somebody who has lost it. So you take the money if you buy and someone sell, they have sold the wrong asset and you have bought the right asset. So it is going to be in your favor to make the money because you bought and somebody sold. Hence, if they sold and you bought, they're going to be in big trouble. They're going to be stopped out. So the money that you make on Forex, it is because someone else out there has lost it. So these institutions, commercial, non-commercial traders, and non-reportables, it is not in their best interest to make losses on the market. But what can we do? Many people lose out on the market because they do not understand or possess enough knowledge to trade the market in the right way. Let's proceed. So let's try to understand the table here about non-commercial traders or hedgers. Who are they or who they are? Okay, so these are large corporations and institutions. Okay, they trade to protect their business, not to profit from price movements. For example, we have airlines hedging fuel prices. Okay, so these airlines, we have different British airlines. They employ commercial traders to work for them. Let me give you an example. If one of us here right now who are on this session, we get employed by a certain company, probably if a company or a corporation that deals with fuel and oil, automatically you become a commercial trader. So you're not going to be trading in your interest, rather you'll be trading in the interest of the company. And every action that you take should be with the mind and thought of the company to protect their funds and to make sure that the fuel price doesn't rise and at the same time doesn't drop. Either way, it is going to affect their business. So we also have another corporation like coffee producers locking bean price. So these, they'll make sure that the price for beans won't drop. If they drop, they'll start making losses and not much profit. If they rise, they will start having few people to buy their product because few people will have access to it. Their goal is to ensure that an average person has access to their products. We also have farmers selling future contracts before harvest. You know, you sell, let's say you have planted a huge sugarcane field. Okay, so these are futures. Futures, it means you buy, okay, to buy something right or prior before it is ready. So selling their futures contract before the harvest, that's what futures means. Now, why they trade? Why do they trade? That is the first question that I asked myself the moment I came across this topic years ago. To reduce business risk, okay? So either the price goes up, it is risking their business. If something becomes too expensive, it is going to only be accessible to few people. And the goal of the business is to make sure that everyone has access to those necessary or necessities in order for us to drive business. And if the price reduces, it is also risking. They won't be making much profit, okay? So airline hedging for fuel, coffee producers locking bean price, farmers selling future contracts before harvest. They trade to reduce business risk, and they ensure stable cost of revenue or revenue, stable cost or revenue. Market impact, provide long-term stability and balance speculative forces. So these are commercial traders, okay? They are also being fought by other type of traders. Let's proceed and see what happens. Here we have the table for non-commercial traders. Let's try to understand their interest. Who are they? Investment funds, banks, professional traders. Okay, so these are investment funds, okay, banks or professional traders. Why do they trade? They trade purely for profit, not business. Let me explain on this. If an individual invest a huge amount of money in a trading, they have no interest in what happens to the commodity. Let me give you an example. If, for instance, a hedge fund manager or portfolio manager decide to sell Apple, those people are so much terrible that they can make sure the price of Apple drops, and they have power. They can just agree together to say, let's sell Apple, the price is too much, and the price will drop. They control what happens on the market. They do what it takes to either make the price of something rise and drop it. And they are doing so purely for profit. And they have capacity enough to move the market wherever they want. So which means if they invest a huge amount of money, regardless of how these hedgers can try, or commercial traders can try to fight against these people, they are using huge chunks of money to move the market. They will penetrate and break out of the consolidation that commercial traders have set to hedge the market. Who are these? Let's try to understand the examples. These are hedge funds buying gold futures, forex traders speculating on USD JPY or any other currency, large investors betting on market trends. Why they trade? Number one, to capitalize on short or long-term trends. Short, it can also mean scalping. It can also mean intraday trade. It can also mean the trade, or to hold for a few days, or even just for 24 hours or for a week. And long-term, it can also mean a 1 or 2 months and above. And then we have they use technical and fundamental analysis, okay, which I will talk about fundamental analysis as we proceed with the sessions. So they use technical and fundamental analysis. What impact do they bring on the market? Number one, they add liquidity on the market. They increase volatility and help determine fair market price. So these guys are insane. They have power. They help to determine the fair market price. If commercial traders, they try to make the price of their goods to rise, these guys, they'll come in. They say, no, there is no way we can be buying one product at 1,000. Let's bring it down. And they are going to do so. Let's proceed. And then we have another third type of a trader, also known as non-reportable traders, or retail or small traders. The other name for non-reportable is a retail. So you and I are retail traders. Retail traders, these are type of traders who have no capacity to be tracked or to be monitored. You can be tracked as a trader only if you have enough funds to move the market or to manipulate the market in simple terms. All right. So they will track your trades and how you are trading. But let's say you and I, we have $1,000, $10,000, even a $200,000, even $1 million, we won't be tracked because that is too small. Okay. So that is the reason why for us to access the market, we go through brokers who happens to be like a middleman between a buyer and a seller. But these commercial traders and non-commercial traders, they go through direct, okay? They can deal with big banks. They can invest, okay, buy huge treasury bonds and bills, government bonds. And the moment they pull out, they can even create an impact in the country. Okay, so who are small traders or non-reportable or retail trader? These are individuals or small firms trading with limited capital, not large enough to report position to regulators. So in the Forex market, there are regulators who track each and every trader, especially those that are big enough. For example, these are independent Forex traders using MetaTrader. So you and I, we are independent Forex traders. We use Meta. Okay, there are different platforms that each type of trader use. Okay, and also there is also a platform or the which we call dark pools. You and I, we have no access to these dark pools. We will explain later as we proceed with the sessions. Student trading crypto, small investor buying oil futures. Why they trade? To earn side income. It is funny, right? To earn side income, learn and gain experience, diversify personal portfolio, the market impact, minimal influence on the price. So you and I, we have no power to control. Our influence is minimal. And that is unless if here I buy and somebody else uses the psychology of the market to buy and other people around the world, they do. That is only when we can create that minimal influence on the market. Activity in crypto, meme stocks, and low cap markets. Okay. Hope it is making sense. Let's proceed. So let's try to understand the regulators. Okay. The regulators, or regulatory oversight. Who is in charge? Okay. So commitments of traders or COT report classifies all traders. There is what we call commitment of traders or COT report. We have regulators, okay, and their role. So regulator, these are CFTC in the United States. They monitors futures, options, and options market. We have CEC. We are going to talk about these regulate equity stock and stock trading. We have ISCO Global. These sets international market standards. Major exchanges or CMC, New York Stock Exchange, enforces trading rules and compliance. So they have specific limitation or principles that they have set in order to create equilibrium on the market so that nobody can cross above those rules. Once they break, they can even be disqualified, okay, and even be answerable to the law. Let's proceed. So how to follow along and practice this court report? Start small. Review court reports weekly to track big players. So how are we going to review court report? Secondly, use trading view. Compare trader activity to price chart. Okay, let's try to understand these 2 points. Review court report, that is the first one. So let's try to go on the court report, okay, or commitment of traders report. Can you see the site called Trading Star from your end, people?
Yeah, we can see it.
Okay, fantastic. So this is Trading Star. Okay, it is a charting tool for an in-depth analysis of commitment of traders report. So what happens? This is going to give you a full information on how many positions, who is in charge of the long position, the sell, the commercial traders, and all those. So it is a free chart. Okay, just have to visit this website called Trading Star. So once you do that, you come here, you're going to see that this here is displaying currencies, okay? There is South African rand, Brazilian real, we have New Zealand dollar, and all that, US dollar, British pound sterling. And then we have grains, soybeans, and all that. We have cryptocurrencies, livestock, and daily indexes, metals. We have treasuries and rates. We have softs. We have energies, and all that. Okay, so I'm busy, no, not fine. I'm busy. And I'm sorry about that. So at the time, you just have, in order for you to understand what is going on, let's try to pick British pound here. So for you to see, you have to come here where it says COT Legacy. Once you click, it will bring you to this page. Okay, COT British Pound Chicago Mercantile Exchange. So you come here. It is going to give you a full details of what is happening on the market here on the chart, which is released every week. Okay, or it should be on Tuesday, okay, or Thursday. So here we have this part, okay, we have this part for non-commercial, here for commercial, and here non-reportable. And here we have this long, which means buy, short for sale. And also it is going to show you the spreads. For commercial traders, we have long and short, and also we have non-reportable long and short. So how do you use this and compare it to TradingView, to your TradingView charts? So if you look here on the non-commercial traders, because non-commercial traders, these guys have influence on the market. So you can see that on the long here, we can see that they open the contracts of GBP. The contracts of GBP as the 2,500. Okay, contracts. There's a difference between a contract and position. And then here we have 104,986 positions long, meaning they bought. And we also have 70,360 sell positions. So they bought and sold. You can see here, there is a negative sign of 4,030 in negative here. They are in positive of 5,662. Now, percentage of open interest for each category. You can see here we have 51.1% of long position. Here we have 37.6% of sell position. And it is also going to give you number of traders in each category. For commercial traders, we have 32 here. Non-commercial traders, and also for their sell position, we have 22. So 32 are bought and the 22 sold. Okay, these are commercial traders. And then here we have commercial traders long and short. So commercial traders, because they hedge to protect their capital, we can see they only opened about 50,320. Here they sold 89,110. Even though they sold this big number, they are in a negative of 10,450. And then here in the positive of 1,400. Okay, so their buying position are showing us 26.9%, and their short position 47.6%. And the number of traders who sold in commercial traders are 40. Here who bought are 27. Okay, just these two. These non-reportable, this is the category where you and I and other small firms fall because of limited capital. So to understand what is happening, let's try to understand, because here British pound was bought, okay, by non-commercial traders, and we can see a huge number. So let's go on the chart here. This is a chart for British pound. Okay, this is a chart for British pound, and you can see the market, how the market moved. Okay, how the market moved. And this drop here, okay, this red candle on a weekly time frame, okay, it is showing a bearish. So now to understand better, let me take you from a weekly to 4-hour time frame. So this here is showing us that here, these were non-commercial traders. They pushed the market, they broke this structure. After they pushed the market, it reached here. Again, if I take you, okay, you guys cannot see the chart.
Yeah, we can see the chart.
Okay, yeah. Can you see it now?
No, we still can't see it.
Okay, let me. Okay, I'm sure you can see it. You'll be able to see it now.
Yeah, we see it now.
Okay, so
Thanks.
this chart here is showing us what happened. Here, the market rose. After the market rose, these were non-commercial traders and also partly commercial traders. But because commercial traders tried to hedge the price and they had to sell more. If I take you back on the chart, you will see that here commercial traders, they had to do 89,110 to sell and 50,320 to buy. And here we can see commercial traders 104,986 they bought and 70,360 they sold. Again, if we go to a chart, you will see the influence and the impact of that. So you can see the market rose and then it dropped. Now, this is where it gets interesting because right now where GBP USD is, it is at the powerful level of a bullish order block there on a 4-hour time frame. You mark, okay? So these guys, they always know. So commercial traders, they invested 104,900 plus. Market reached here. Again, the non-commercial traders, they tried to hedge. They invested 89,000 to sell and 50,000 to buy. Again, the market dropped. Okay, so you can see that if we go back on the COT report, this is going to sound a little bit difficult. If we go back on the COT report, you see that because of that drop, non-commercial traders, they are in a negative of 4,030. This can also simply means that this can be 4,030 positions in negative. In 5,627, when the market dropped, they also did invest. Now, you understand that these guys know their levels, okay? They know their levels. So if you look here there is a level of a bearish order block. And if we try to use a daily time frame, this is what we are going to see on a daily time frame. And on a daily time frame, we are able to see using a long-term perspective that the market is still pushing, okay? It is still in a bullish direction and the market is still moving. We should expect the market to reach this point of interest, which is that level. And the market, what we are seeing here is just a retracement using one single candle, a daily time frame. And they did drop, coming to test this bullish order block, which I'm going to mark in yellow there. Okay, this daily bullish order block. And we can see the market is showing some lower price rejection just below there. Is it making sense, guys?
Yeah, it is making sense.
Okay, don't worry, you understand as time goes on. So, what this happens, let me simplify this. This helps you to understand and get a glimpse of what is happening in the market inside. For example, if you look here, you will be able to know how to trade your positions, especially if you are thinking in a long term or short term. You will be able to have a glimpse of what is going to happen in the future. Because of these contract sizes, you are able to go along with where the market is going. And you can see that 104,986, this is the highest contract, okay, in GBP, where these non-commercial traders, they bought. And 70,360, they sold. 50,320 from commercial traders, they invested about 50,320 worthy of contract and 89,110 worthy of contract in a sell position for commercial traders here. Yes, Mr. Makasa, ask.
Yeah. Uh, okay, I'm like a little bit left behind. There's
Okay.
like these on commercial, there's
Mhm.
long and short, right?
Yeah,
Um, the positive, what do they actually mean? And the negative, do the positive actually mean the gains
yeah,
and the negative mean the losses?
exactly. That's what it means.
Okay, okay,
That's what it
right.
means. So you can see here, um, don't worry, Sister Doris. At first, it's a little bit complicated, but we are going to repeat it again in the next session, so that we all get to both understand. We all get to understand, and also to do both analyze and also take trades. So here you can see now, after we understand, here we have non-reportables. These they entered 30,248 buy and 26,084 sell. Now here we have total of all the contracts for all types of traders. Okay, so here we can see long position.